Forex Focus brought to you by IG. Taking a look at the inflation data that's coming here this week in the US, it's going to be a really relevant one for a number of reasons, for obviously trading of US dollar pairs, but also even before that, where the Fed sees interest rates going. But first, let's talk about this number that's set to come out Thursday morning, I believe 8:30 Eastern time. There's two different numbers that you're going to primarily be looking at. That's going to be the headline inflation number, so all parts of the consumer price index. And then, as we'll get to in a second, the core section of inflation, which is all these items minus food and energy that can be very volatile, as we've seen in the spike and then fall of inflation. And you see here, looking at that headline inflation number, been as high as 9% and now off considerably. The previous reading was 3%, leading you to believe that, man, this inflation thing seems pretty under control. They want inflation around 2%. The expectation is actually a little bit higher here at 3.3%, but still seemingly under control, right? Well off of those 9% highs. But the Fed has been looking closer at core inflation, which makes sense. You look at this line here, just going back and forth, the added line that doesn't get so high as the headline inflation, but definitely hasn't come off nearly as much. This is a core inflation number that's peaked around 6-7% and is still previous and expected around 5% here. And this is what Fed Chair Powell said that they're primarily looking at when looking at the future pace of interest rate either hikes or cuts that the market has priced in for the next several months. Just as a little bit of background, the core inflation number, why do they strip out that food and energy? Well, take, for instance, this most recent run-up in inflation. A lot of what went into that 9% high was having to do with the Russian-Ukrainian war. And when that first initiated, you saw a spike in crude oil prices and wheat prices, primary commodities for food and energy. And as the war has continued, some of those prices have come lower. I mean, crude oil and wheat are considerably lower from those highs, and you saw inflation lower with that. But the Fed and everyone can say, oh, okay, well, yeah, that was a cause and effect of this war, but inflation outside of those food and energy costs is still sticky when you're looking at, other costs here that are listed outside of those two markets that were primarily affected by that war. And so they're still looking for this number to get down to 2% and have kept interest rates high, around 5% or higher, depending on what part of the U.S. Treasury curve you're looking at. The Fed obviously affects just the overnight Fed funds rate, which is at around 5.5% now, and potentially moving higher. You see the 2-year, while it's not necessarily north of 5% or indicating an interest rate hike to 6% or what have you at the next FOMC meeting, it is holding on to those highs. And we saw in the early part of 2023, in the March, April, May range, interest rate markets moved off of those highs with the idea that actually inflation's moving lower and the Fed might normalize interest rates lower, maybe cut interest rates by the end of 2023. Since then, the yield market or interest rate market has bounced back with the idea that actually they might not only keep rates high here at around 5.5%, but maybe they do get up to 6%. There's a small, albeit outside chance of that, but more of a chance than a few months ago when the expectation was rate cuts by the end of 2023. There's a little bit of a chance of another hike or two by the end of the year. And Fed Chair Powell has said over the course of this summer that he expects inflation to stay high for at least the next 6 months. He doesn't think that their job is done. And a lot of that speak coming from the European Central Bank panel in Portugal at the end of June. And so he thinks this is a continuing story. The expectation is still at around 5%, 4.8%, the expectation for core inflation here, much higher than the 2% target. All of that being said, Nonfarm did come in a little bit lower than expected, which I think caught a lot of people off guard. We saw an employment data point come out earlier in the week that was higher than expected. I think led a lot of traders to believe that this non-farm was going to come in much higher than where it was expected, around 200K. But no, comes in at 187, only the second time in the last year worth of non-farm payroll data that it's been under 200K, which has given us a lot of mixed signals, which should potentially give this coming inflation rate a lot of potential volatility here. If you've got, the Fed saying they're worried about inflation staying high, you've got non-farm payrolls and other employment data speaking out of both sides of their mouth. Maybe inflation will come higher, maybe it'll come lower. And then you've got this expectation of 4.8%. And I think with markets like dollar yen or euro dollar that have centered up a little bit of the last couple of weeks range, kind of waiting to see it in this mode of, if you come in at 4.8% exactly with the inflation number this week, then okay, maybe we don't really move that much. It's a little bit of a knee-jerk reaction off the number, but nothing too substantial. If you come in higher than expected on the inflation number, maybe you see that US dollar resurgence continue. As we've seen since early July, dollar has definitely made back some ground that it lost for the early part of this year against yen, against euro, against pound as well. If that inflation number comes in weaker, maybe a 4.6, 4.5, somewhere in that range, then interest rate markets in the US maybe come off. The expectation for higher rates is no longer there. And some of this US dollar strength is undone, and yen's able to fight back. Euro's able to fight back. Pound, which has been one of the strongest of the three, is maybe able to get back to 130. Either way, in a little bit of a wait and see mode across interest rates and forex, and a little bit in stocks as well, as they've picked up in correlation to interest rates and inflation over the course of the last couple of weeks, heading into this CPI number that's coming on Thursday morning.